Hey guys, this is Tagene Brown-McBean from Money Coaching Services, and today we are going to be talking to you about how to calculate a debt service ratio to buy a house. So we're going to show you how to do the calculations, what to expect, what your monthly mortgage payments, how much would you qualify for. So let's get into the video. So watch till the end. Those of you who are planning to buy a house, yes, this will be very helpful. All right. So I am Tagene Brown-McBean from Money Coaching Services, and I have been in banking for over 18 years. Wow. 17 years at Bank of Nova Scotia and 1 year at GN Bank. So today I will be helping you to understand how to use a debt to income ratio to know how much mortgage you can qualify for. Okay? All right. So let's go. So how to calculate debt to income ratio to buy a house. All right, so the formula for a debt to income ratio calculation is your total monthly debt payments times 100 divided by your gross monthly income. So some of you might be saying, what is a debt to income ratio? No, a debt to income ratio is a calculation that the banks use to see how well you are managing your debt. And they also use it as a measurement to see if you can actually take more debt, if you can take more loans, if you can take a mortgage, or so on. But for today's presentation, I'm only going to be focusing on getting a mortgage. Okay? All right. Good. So, first thing you're going to do is you're going to add up all your monthly debt payments. So, for this example, you have a furniture loan that is 19,000 per month. You have a car loan that is 30,000 per month. You have a student loan that is 20,000 per month. And all of your debt payments for the month total 69,000 per month. Okay, so this is the first step. The next step now is, how does this come together? So for the calculation to be done, you need your total monthly debt payments, which is 69,000, and you need your gross monthly income, which is 300,000. Now, your gross monthly income is your income before tax and deductions. Okay, people? All right, good. So here is the formula. And now we have inputted your information. So 69,000, that is your total debt payment for the month, times 100 divided by 300,000, which is your gross monthly income. And we get 23%. All right. So we're moving along. So your debt to income ratio is 23%. So we are going to go to the next step, which is to explain what percentage the banks will use and how it affects you. All right, or could use. because they have different percentages. All right. So the bank approval rate may differ bank to bank. So it might range from 40% to 50%. But for this demonstration, we're going to use 45% because it is the percentage that most banks would use, or you'd fall into that category that you'd have more banks using that percentage for you to qualify for the mortgage. All right. So here we go. Your current debt payments plus your mortgage payments must be less than or equal to 45% of your gross income. Okay, so below we have your gross income, 300,000 times the 45% rate that the bank is using to say how much dollar value will you qualify for, including your current debt. So this 135,000 does not represent your mortgage payment. It represents your current debt payment plus any additional mortgage payments that you would qualify for. Okay, people? So now we're going to break it down now and show you how much monthly payment you could qualify for, and this would be the maximum. We're calculating the maximum. Okay. All right. So the maximum payment that you can afford for a mortgage, if your bank says you're using a 45% approval rate, so this is what is going to happen. So you're going to subtract the bank's maximum debt payments from your current debt payments. So the maximum is 135,000. Subtract the 69,000 that you currently have for your total loans as a monthly payment. And what we're left with is 66,000 per month. All right, so this 66,000 represents your maximum payment that you can afford for a mortgage. 66,000 per month. All right. So any questions, please put them in the chat. Chat. We are here to have a conversation. We're here to enlighten you. We're here to give you the knowledge that is important for you to do some financial assessments, so we have an idea what to expect and how far away are you from your goal of getting a mortgage, people. So some of you might be saying, so okay, suppose I exceed what the bank is looking for. What do I do? Excellent question. Excellent question. So we're going to show you what to do if you basically don't fall into the category of qualifying for a mortgage. What do you do? Here is what you do. To increase the maximum monthly amount for a mortgage, do this. 1, simply pay off at least one of the existing debt, right? Number two, what will happen is that your debt to income ratio will reduce. And three, your monthly payment for mortgage that you qualify for will naturally increase. So you have the option of reducing your debt, reducing your existing debt, and also remember, people, if you can increase your income, it also increases how much monthly payments you can qualify for a mortgage. All right, so let's give you an example. So this example now is if you paid off that furniture loan for $19,000 per month, right? What happened? So you don't even have to pay it off first. What you can do is do the calculation as if you paid off the furniture loan, and you run the numbers and you will see what the result is. Okay? All right, so we are gonna subtract the bank's maximum, which is calculated based on your current income. So we are going to assume that your current income is still 300,000. People, stay with me. Don't go anywhere. All right. So 45% is what the bank is using as their calculation. That's what we're using for this scenario. Okay. All right. And that would be equivalent to 135,000 per month. This is the maximum that your current debt plus the monthly mortgage amount would total to. When you add them together, it cannot exceed this amount. Okay? All right. So this 135,000, we're going to subtract not 69,000 as we had in the previous example, because we are now taking into consideration that we have paid off the furniture loan, which was 19,000 per month. So now we are left with 50,000 as our total current debt payments for the month. So as you can see, gentle people, when we subtract this 50,000 from the 135,000, the amount that we now can access is 85,000. So instead of going back, instead of 66,000 per month that you would have qualified for as your mortgage payment because you had the furniture loan in there. Now we have subtracted the furniture loan and we have freed up $19,000 additional per month. Now you qualify for $85,000 per month as the maximum. You hear, people? Maximum, right? That would be your monthly mortgage payments. Okay. As a personal advice to you, even though this 85,000 is the maximum, we recommend that you do not go exactly to the maximum, right? Don't leave a little space in the budget for you to still be able to do your savings and other little things, saving for your emergency fund and so on, right? Do not at any point in time do any calculation where you have no savings, no emergency fund, that if anything happens, that you're gonna not be able to pay the mortgage payments, because things happen. So because things are always happening, we don't want you to be able to qualify for this lovely mortgage that you have been dreaming about getting, and because the other parts of your budget are up to the max, there's no breathing room in your budget. You need some breathing room in your budget for an emergency fund, just in case anything happens, that you can still pay your mortgage. It is nice to qualify for a mortgage, but it is even better to be able to make the payments. So as a backup, don't go for the max unless you have a fully funded emergency fund, which is 3 to 6 months of your monthly expenses. That's what most people say, but actually it's supposed to be 3 to 6 months of your monthly income. But some people spend over their income. So because some people spend a little bit more than their income, so most coaches, money coaches, and financial advisors will say to you, all right, use total monthly expenses, because that will capture everything. So 3 to 6 months of your total monthly expenses as an emergency fund. Only at that time will you consider using the maximum amount, this maximum 85,000 per month, to go towards a mortgage. Any questions, people? I need your questions, any comments? Have you ever seen a calculation like this? Did you know you can do this calculation for yourself to at least have an idea what to expect? People, this channel is about education, educating you as to what is possible, what is practical, and yes, taking you out of the darkness, because a lot of things that you learn about money are what we call ABC. You're learning the 1, 2, 3, where we're leveling all of our clients and YouTube persons from that level. Cannot create the type of life that you want with that information. So we're giving you the next level. We're leveling up the information you get so that you can do more and be more. Oh my God. Yeah. So for my clients, I help them. So this is the end of the presentation. So comment, tell me, those of you who watched, I have a previous video on debt to income ratio. So some of you might have watched that. Do you know what a debt to income ratio is? Have you heard this for the first time? Did you know you could do a calculation to help you to assess whether you are able to qualify for a mortgage? People. All right. So as I said, this is Tagene Brown-McBean from Money Coaching Services, and I am your money coach, right? I am the author of the book, Money Moves That Matter, Simple Steps to Become Debt-Free, and that is on Amazon. And also, you can check out our website at moneycoachingservices.com. Yeah, moneycoachingservices.com, where we give you the tips that you need to level up your finances. Okay, so I'm gonna stop sharing. Yes, guys, so this debt to income ratio can help you in general to determine if you can take on more debt. It will also tell you if you have too much debt, the things that you can do. You can increase your income and you can reduce your current debt. That is how you fix that problem. And I want you guys to hit the notification bell. I want you to subscribe. I want you to share this video because a lot of persons are thinking about the next step of getting a home. Some people might be also thinking about getting a second home before they retire. So this video is also helpful. They can use it as well because most people do not know that they can do a calculation like this so that it is easier for them now to know where in the process they are. If they are close to their goal, if they are far away from their goal, you understand this calculation helps you to determine how much work you need to do to reach to where you want to go. All right. So we also provide consultation for persons who want to pay off their mortgage early, right? As I said to you before, I paid off my mortgage early. I paid off my mortgage 17 years early, right? And we can show you how to pay off your mortgage early. Now, I cannot promise you that you will also pay off your 17 years early because I do not know if you have a mortgage, if you've just gotten the mortgage, if you're in the process of soon ending the mortgage, because what happens is that the closer you are to the end of the mortgage, yes, to finally paying off the mortgage in full, is the less money you can save. So let me make that disclaimer. So the persons who are in their first 5 years of the mortgage are the ones who are going to save the most. And with that savings, you're gonna save money that is equivalent to what some of you are expecting as investments. So I will not go any further than that, except to say that paying off your mortgage has guaranteed financial benefits. It is not only the fact that you have stopped paying the mortgage, there is actual financial benefits in the sense that the total interest cost dollar value is significantly, drastically lower than what you're paying now. Let me say that again. Paying off your mortgage early pays. And when you come into a session with me, I will show you the calculation. All right, so a quick tip for you. It's gonna open your eyes. I'm gonna show you something. Quick tip. For those of you who have a mortgage, what you're gonna do, multiply your monthly payments. Say your mortgage is, you're paying 150,000 per month for your mortgage. All right, some of you are not paying so much. I'm just giving an example. Times the number of years times 12. Now, what you get as the end figure is the total cost of the mortgage. It includes the principal and the total interest cost. So what I want you to do, when you get the final figure, subtract the principal from it. What is left is the total interest cost the bank is charging you because you think you must sit down and pay a mortgage for 30 years. You're going to realize that the amount that you're paying, say your mortgage is 25 million, example, you will not be paying 25 million to pay off the mortgage. You'll not even be paying 30 million. You'll be paying between 50 to $75 million to pay off your mortgage, depending on your interest rate. People get with the program. And it depends on the number of years as well. So if you have a 30-year mortgage and your mortgage was 25 million and you made a down payment of 10%, then what you will be left with is 22,500,000, and the total cost of that mortgage at 9% will be 65 million. 65 million for a $22.5 million mortgage. You notice I never said 25 million because you already made the down payment of 10% for the difference. I'm not counting that. $65 million is what you're going to pay for a 30-year mortgage at 9% for a $25 million house that you have paid a down payment of 10%. So this is the reason why I coach my clients on how to reduce the total interest costs. So that's a difference of how much, people? That's a difference in interest costs of almost $43 million for your $22.5 million mortgage. Yep, $43 million going to the bank because you think you must sit down and pay the mortgage for 30 years. Wake up. Wake up. Yes, and when the banks tell you, oh, don't pay off your mortgage early, you can take the money and invest. Now tell the people, is there anything that is out there that is guaranteed to give you $43 million? I rest my case. That's the end of this video. Spoiler. Oh, sorry. I remember also I'm supposed to do some big ups. Big up. So I'll be doing some big ups for persons. Yeah, big up. So I want to big up the persons who have commented on the videos. Yeah, we appreciate that you're commenting on the videos. So today's big up is for Tagene Brown. So Tagene Brown had commented on our video on expenses, right? So hold on one sec, people. Give me a minute. Give me a minute. So yes, Tagene Brown commented on 3 strategies to reduce your expenses video. And Tagene Brown, this is your big up for today. Thank you for your comments. Thank you for your feedback. And we appreciate it. Love you guys. Take care and all the best with managing your finances, and have a great day. Remember, hit the notification bell and subscribe. You don't want to miss a thing, because each of our videos, I want to give you something that you can use today to improve your situation, or at least calculate where you are so you know where you're going. All right, guys, have a great day. And if you can watch more videos, go ahead, watch some more videos. If not, then